Welcome back to Investing Talk podcast.
Today we're looking at NBIS Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. NBIS Group is, well, they're a really fascinating company. They position themselves as a dominant, full-stack AI infrastructure enabler.
And not just in one region, right? They're global.
Exactly. We're talking North America, Europe, Israel. And the key thing to understand is they have these proprietary assets like Toloka for data and 1010 for edtech that sort of reinforce this whole AI ecosystem they're building.
It's that full stack idea. It's not just about renting out servers.
Precisely. And that's showing up in the numbers. The revenue acceleration is, well, it's massive.
Let's put some figures on that. The growth here really outpaces anything you'd call average for the sector.
It really does. So their trailing 12-month revenue is sitting at $363.3 million.
Okay, a solid number, but that's not the whole story.
Not even close. The consensus projection for 2026 is $1.86 billion.
Wow.
Yeah. That's a staggering 214.7% growth from what analysts are estimating for 2025. It's pure market capture velocity.
You don't see numbers like that without some kind of serious competitive advantage, a real moat.
And that's where the conversation gets really interesting. For them, it boils down to one huge piece of validation.
You're talking about the Microsoft partnership.
The Microsoft partnership. That confirms $17.4 billion deal. It's a game changer.
How so? I mean, beyond the obvious cash infusion.
Well, it locks in demand at a hyperscale level. It's not just money, it's technical credibility. It says to the entire market that their infrastructure can handle the absolute peak of industrial scale.
That's a huge stamp of approval. But with that kind of rapid scaling, what do the profitability metrics look like? Because growth is one thing, but margins are another.
And that's the surprising part. For our hardware-heavy business, their margin profile is incredibly strong.
Strong how?
Gross margin is, get this, 59.12%.
59% on infrastructure.
Yep. And the net margin is 31.43%. Plus, the consensus is that they'll transition to a positive EPS, about $0.22 by 2026.
That is exceptionally high. That really speaks to the power of that proprietary software layer you mentioned.
It does, but, there's always a trade-off. There's a nuance here.
Right. This is where we get to the main concern. This hypergrowth has to come at a cost, and I'm guessing that cost is high. The recent quarterly results suggest some pretty heavy spending.
That's the other side of the coin. If you look at Q3 2025, the specifics are pretty stark. Revenue was strong, sure, $302.1 million. But they posted a net loss of $229.1 million from continuing operations.
Oof. That is a serious burn rate.
It is. They are burning through cash to fuel that growth.
And this brings up the risks, right? The risks around their capital structure and just general operational management. Can they handle this pace?
That's the billion-dollar question. I mean, their debt-to-equity ratio is moderate for a company like this, sitting at 85.4%.
So they have some runway?
They do. But analysts have definitely flagged execution and margin risk. You have rising capital expenditures, regulatory costs. All of that could start to squeeze future margins if they're not careful.
And there are real-world examples of this, aren't there?
Yeah, back in October 2025, there were reports of supply chain bottlenecks that were directly impacting server installations.
So you can have the biggest contract in the world, but if you can't physically get the hardware in the ground and powered on, it doesn't mean much.
Exactly. It's a constant battle.
So to sort of sum up the financial picture, it's a classic growth stock scenario. You have this massive top-line expansion, but it's being offset by equally massive investment needed to grab that market share.
It's the ultimate balancing act. And you can see that tension reflected perfectly in the stock's technical picture.
Okay, so let's shift gears. How is the market pricing all of this in?
Well, the stock is trading well above its long-term moving averages. There's no doubt it's in a strong uptrend. But, and there's a big but, it comes with extreme volatility.
And the recent price action really tells that story. I was looking at this just before we started. As of mid-November 2025.
The numbers are wild.
Year over year, the stock is up 374.7%.
Just incredible.
But it's also suffered this really steep recent correction. It was down 33.6% in the prior month alone after that huge parabolic rally.
A brutal drawdown. But the key thing for the bulls is that the price seems to be stabilizing. It's finding what looks like strong support above that $80 level.
So the pullback might actually be creating a healthier entry point.
That's the argument. But you have to be prepared for the ride. The volatility is still incredibly high. We're talking about an average weekly price swing of 17.4%.
17% a week.
Yeah, let that sink in. This is not a stock for the faint of heart. You need to be able to stomach some serious swings.
Absolutely. So for investors who do have that risk tolerance, the next few months look absolutely packed. There are several major inflection points coming up.
The calendar is very busy. The first thing on the radar is the Q4 earnings pre-announcement. That's on December 19, 2025.
And that's going to be crucial for clarity on the margins, right? After that huge Q3 loss.
Exactly. Everyone will be watching to see if that burn rate is coming under control.
And then what's next?
Right after the new year, January 5, 2026, there's a major ETF rebalancing event. There's a lot of talk about potential index inclusion.
Which would trigger automatic buying from passive funds.
The big potential boost to demand, yes. And then the main event is the full Q4 and fiscal year 2025 earnings release on February 20, 2026.
And expectations are sky high for that one.
The street is looking for greater than 100% year-over-year revenue growth. They really need to hit that triple-digit mark to justify everything.
So what's the general feeling out there? Is the market buying this story?
The conviction seems very high. All 4 analysts covering NBIS Group rated a strong buy.
And their price targets?
The average target implies over 80% upside from here.
That's a huge vote of confidence.
It is. And that kind of sentiment naturally fuels a lot of speculative buzz. There are a few key rumors that could act as unexpected catalysts.
Like what?
Well, there's ongoing chatter about a potential acquisition to expand their European cloud footprint.
Which would help diversify away from that one big Microsoft deal.
Exactly. And tying back to the execution risk, there are also rumors there are negotiations for exclusive access to next-gen GPUs from a top semiconductor company.
Now, that would be huge. Locking in your supply chain like that would be a massive competitive advantage. It would take a major risk off the table.
It would be the ultimate defensive move.
Yeah.
And then you even hear whispers of potential S&P 500 fast-track consideration if they hit their numbers.
So let's bring this all together. The overall thesis seems to be, what, a 9 out of 10 bullish? It seems like the structural AI tailwinds are just too strong to ignore.
I think so. And that recent technical pullback really sets up a much healthier entry point than what we saw a month ago.
But we have to end on the risks, because they are very real.
Absolutely. You have to be eyes wide open here.
Yeah.
The sector rivalry is intense. I mean, we're talking about global tech giants, not small startups. And there's always the risk from the open source community.
And we can't say it enough, the high volatility. It makes the stock suitable only for investors who are really comfortable with significant price swings.
For those investors, though, it's an interesting play. It's attractive for short-term swing trades targeting those earnings dates we talked about.
But it's also a potential high-conviction compounder for the long term. If you believe in the secular growth of AI and cloud, this is right at the heart of it.
Right. And if we connect this to the bigger picture, the sustainability of NBIS Group's growth isn't just about revenue. It's about whether their proprietary assets, like Toloka and Triple Ten, can successfully translate that first-mover advantage in infrastructure into long-term dominance in the application layer. That's the real question, defining its multi-year trajectory.